Everybody, we're just waiting for everybody to be linked and join. So we've got quite a significant number of people today, which we are very thankful and grateful for. So if you can just bear with us for 1 minute while we just allow the attendees to come through. Kavita and Nadir will start pretty soon. I can see the numbers are still coming in a bit, so please just bear with us for 1 more minute.
Perfect.
And just for everybody's purposes, we will ensure we do keep it on time and steady, and everything included of what we want to be able to cover. All right, perfect. Just checking with the team. Also good. We've got a couple more people that are getting through. All right, let me see the team know. Okay, perfect. Well, I think everybody will keep joining as we go through, but I've got a bit of an introduction just to obviously kick us off. So I just want to thank everybody and a good morning. So thank you for attending today. So I'm quite excited about this conversation. It's essentially a 101 introduction to hedge funds and also an opportunity for us to debunk some of the perceptions around hedge funds. So to give you an idea, amongst the South African retirement investors, the awareness of the hedge funds actually doubled between 2022 and 2025. But some of the myths around cost and risk has actually remained a primary barrier for this, which we'll go through. Now, for me, this is an incredibly valuable asset class for diversification, downside protection, and actually providing steady returns in a person's investment strategy. So the question always is, and Kavita will smile at this, is why now and is this new? So this hasn't been something available or typically used by many financial advisors or firms in South Africa or actually across some of the countries. This has typically been more reserved for your institutional investors. Obviously, through our group's scale and strategy and relationships, we are able to bring this to our clients. Now, to give you an idea, less than 5% of South African advisors actively recommended hedge funds in 2018. So since 2022, this figure has risen to about 20%, which has also been driven by regulatory change, a good change in the regulations to allow a greater access, but also outcome-based advice, which Kavita will be able to give us an idea for. All right, so for some, this is going to be your first interaction with this conversation, which is absolutely perfect. We want to keep the session practical, visual, and an introduction. So we've got some set questions for the Q&A, but we're going to be keeping it punchy. We're going to look at some of the key topics and cover quite a breadth of it. Before we do, let me introduce myself. So I'm the Managing Director of 1618 International. We're the offshore advisory and wealth management arm for the group. So we focus on how to support our clients in best utilizing their offshore planning with their SA products and balance sheet for retirement planning, savings in harder currency, tax planning, and residency. Now, I also do oversee the group's investment strategy with our in-house Category 2 licensed investment manager, Fibonacci, which is a purpose-built company in our group to provide the guardrails for our clients and advisors, where we actively source and vet investment opportunities to engage with the caliber of managers like Peregrine. The group also holds an asset consultancy with Alexforbes, where we leverage their research, their market relationships, and all the capabilities of our models and funds. So really giving us one of the most robust offerings and cost-effective solutions in the market. Now, there's going to be a lot of information. So there's 4 things that I'd love for you to take away today. Number 1, it's not your job to fully understand today. 1618's client experience and strategy is about ongoing review and how best to improve continually. So just enjoy the webinar. Secondly, the hedge funds are not what we see in the movies. They are purpose-built to achieve what I've mentioned earlier and to effectively not be market correlated, which is a very important point for today. And certain types of strategies can be comparable to the risk profiles of like your fixed income government bond or company bond. So you'll see that from a debt perspective, but returns are just slightly lower than what you'd get from an equity market. So a good bang for your buck. The third part, which links to the one I just mentioned, it's a highly regulated market and investment vehicle, and managers like Peregrine are specialists and only do hedge funds and have done so for decades. And the last point really is to give you the best retirement possible, which is leading up to retirement and in retirement. It really is important to use and consider all vehicles that can give your hard-earned money longevity and a smoother journey. Now, retail hedge fund assets under management have grown quite extensively between 2021 and 2025 by an estimated 70%. There is a sign of increasing adoption, and it is an increasing sign in terms of the broader product range for retirement savers. So with that, I'd like to introduce and ask Kavita just to give us a bit of background to herself and also to who is Peregrine.
Thanks so much, Ian. Good morning, everyone. Ian, thanks for having us. In terms of my own background, I started off my career in international tax, and then I quickly moved into a portfolio management role. And for a large part of my career, almost 15 years, I used to manage private client portfolios. First, I looked at mostly the equity space, and prior to joining Peregrine Capital, I was with a family office. And that's really where I got a broader overview of different asset classes available, such as the hedge fund space. That's where I did the due diligence on hedge funds in South Africa and got to know Peregrine Capital and the team. In terms of an introduction to Peregrine, as Ian mentioned, we are the first hedge fund manager in South Africa, currently the largest. We are very focused in what we do. So how we differentiate ourselves is we don't have very many different strategies. We're a business that was launched in 1998, so we've been running for 27 years. We run two of the best performing hedge funds. I think a key differentiator as well is that a large amount of our own wealth is invested alongside our clients. So our investment team come into the office every day, and really they see their job as managing their own money. And the core focus of the business is to protect clients from losing capital. And from there, how do we generate very consistent returns?
Excellent. And diversion, we just covered it now. What is the relationship with the Centenary and the rugby?
That's actually a very exciting initiative that we've launched. And the reason is, if you look at one of our funds, the High Growth Fund, it's been running for 24 years, and it's one of the best performing funds in the market. It's the first fund in South Africa to achieve 100 times return on capital for clients. So what that means is if you had invested R1 million when the fund was launched 24 years ago, currently your assets would be worth 190 million. So it's a first fund in South Africa to achieve over 100 times return on capital for clients. And that's kind of what inspired the initiative with the rugby Centurions.
Excellent. Okay, well, that's very interesting. I think it's always nice to know the background. Thank you. Nadir, if I can quickly just get to you. So what is your background, and can you just give a bit more of how Alexforbes is supporting 1618 and obviously with the Fibonacci team?
Yeah, thanks, Ian, and good morning to all your listeners and your viewers. So a little bit of my background: I've been in the industry for 15 years. I've worked in multi-manager research and investment research my entire career. And I joined Alexforbes 3 years ago. And Alexforbes' role and partnership with 1618 is really about providing the best of Alexforbes' research into 1618. So, that would be manager research, so uncovering, asset managers, the likes of Peregrine, which are available in the 1618 solutions. It would be include things like asset allocation decisions and asset allocation research, as well as a partnership with the world's largest multi-manager, Mercer, and bringing global manager research into 1618's international as well. So my role, Ian, is really to bring the best of Alexforbes' 30-year history in investments and, Mercer's much longer history in investments at much larger scale, and bring the best of that thinking and uncovering the gems like Peregrine on behalf of 1618's clients.
Excellent. Thanks, Nadir. Kavita, the last figures were about 6% of the South African retirement and pension funds are currently allocated to the alternative investment space. So Why is this conversation meaningful for retirement? And it is not just for high net worth individuals. Why is this relevant for the normal South Africans?
So I think if we look at the hedge fund asset class, a key benefit is the ability for hedge fund managers to protect clients from losing capital during market drawdowns. So as an example, during 2008, when the markets drew down 40%, one of our funds, the longest running fund, Pure Hedge, was up for the year. So it really has the ability to protect clients from losing capital, losing money, and providing a much smoother journey for them. And as you know, as a client gets closer to retirement, capital preservation is vital.
That's interesting. So, I mean, that's one of the key things I touched there, for it not to be market correlated. So when majority of your funds, so probably 90% of your overall balance sheet or portfolio is in market related funds, you're obviously going to go through the dips and the highs and the lows. This is an asset class that can provide that diversification and also the opportunity for less on the downside risk. I mean, that's kind of what you were touching on.
Correct. Yeah, I mean, it's a really big benefit. A key characteristic is that hedge funds don't track that benchmark. So if you look at all the funds in the South African market, specifically the balance funds or the equity funds, if you look at the correlation, and what correlation means is if you have 80 to 90% correlation with the market, the behavior of the funds will mimic the overall direction of the market. So say the market is down 10%, these funds are likely to be down 8 to 10%, whereas a hedge fund manager don't look to track a benchmark. The core strategy of a hedge fund manager is to generate absolute positive returns for clients, regardless of what the overall market is doing.
Okay, and we are going to get to how you do that. I know the back of everybody's mind is going, what do you do and how do you do that? But I think one of our pieces of research before I asked Nadir about the retail investors was, I think it was your Peregrine High Growth Fund in 2020. The market, the JSE actually fell by, I think it was negative 16.7 by our look through, where the fund was only negative 0.8. So as a means for diversification and protecting the retirement downside, I mean, that just illustrates it from a pure number perspective. So we're going to get back to how this is achieved, because I think that's one of the key things. Nadir, is this available to all retail investors? Why is this an important allocation for our group strategies?
Yeah, so Ian, I mean, you mentioned it at the start of the webinar that regulation around these vehicles has drastically improved over the last couple of years. And, what that's meant is that hedge funds have actually come, into the regulatory environment just like a unit trust is regulated, so you get retail investor hedge funds, that are regulated on a like-for-like basis, just like any other unit trust. There's kind of 1,700 odd unit trusts out there. And all these retail hedge funds are regulated on a like-for-like basis, just like these unit trust portfolios. What is an important distinction to make, though, is that in order to access hedge funds and hedge fund managers, in order to invest in hedge funds or manage a fund of hedge funds like 1618 is doing, you've got to have something called a Category 2A discretionary license. And that's obviously a different license to just a pure investment management license. And having that discretionary Category 2A license does put you at a significant advantage in order to get access to these sorts of vehicles, that can be uncorrelated to markets, that can smooth out returns over the long term. So that Category 2A license that 1618 has really is vital in getting the end retail clients access to these vehicles.
That's a good point.
And I think maybe if I could just jump in, Ian, I think that's a key differentiator. I mean, as my role as an investment specialist, I deal with many different types of financial advisors, family offices, etc. And you mentioned the growth in the retail market in terms of accessing hedge fund managers, but there is that license category need. So that kind of it does limit the broader market in terms of accessing hedge funds, accessing the strategies. So it really is a nice differentiator for advisors to include hedge funds in clients' portfolios.
Yeah, it's a very key one. It was a very strategic decision that was made. So two of the other directors and myself are actually under supervision for Category 2A, and the decision was exactly this: the ability for us to provide more products and be able to do it from a licensed regulated perspective. So Kavita, let's get into it now. So what would you define is a hedge fund? Are there different types?
That's a great question. I'm just going to share some slides with you. I do want to very simply go into the definition of a hedge fund. Just let me know once you can see my screen.
Yep.
Okay, perfect. So very simply, a hedge fund pools investors' money and appoints a professional manager with the necessary qualifications to invest in shares, bonds, and other securities, much like other CIS funds. So as Nadir mentioned, in 2015, the FSCA included hedge funds under CISCA. So we are regulated in exactly the same way as any other funds, such as Allen Gray, Coronation, 91. We operate within a CIS structure. There are different strategies, but before I go into that, Ian, I just want to give an overview of what the perception may be. As mentioned, I was client facing, and I think the perception across the board was that hedge funds are high risk, highly volatile, expensive, not accessible. And what has really formed this perception is what we hear about the offshore markets. And the offshore space operates very differently. Firstly, it's not a regulated environment, so you do have a wide variety of mandates. So on one side of the spectrum, you have very conservative mandates. On the opposite side, you do have very aggressive mandates, managers taking single stock bets, very activist about it, and they end up doing extremely well or kind of bombing out completely. Shows like Billions or Wolf of Wall Street come to mind. So the reality in South Africa is that hedge fund managers are generally quite conservative or moderate in terms of their profile. And the reason is because of the regulation. So including hedge funds can actually reduce the volatility of your client's overall portfolio. As Nadir mentioned, you do need a special license category, but the likes of our funds are available across all list platforms. So with the change in regulation, we are now a daily traded fund, so there's the daily liquidity. So it's definitely a lot more accessible and a lot more available to include it in a broader client portfolio. And in doing so, you can actually reduce the risk. And in reducing the risk, it will provide a more consistent return profile for clients. Perhaps I can just go through some key characteristics, which I think is very important for advisors to know when they speak about hedge funds to clients. I've mentioned, and Nadir has mentioned, that we are regulated CIS. If you look at what hedge funds invest in, it's exactly the same asset classes as a balanced fund. So that's listed equity, listed property, fixed income. There's nothing obscure or illiquid that you or your clients wouldn't be aware about. So for us, liquidity is key, similar to the other hedge fund managers in the broader market. And your question was, are there different risk profiles? So there are, even in the South African space, there are very different strategies. So hedge fund managers have different tools at their disposal to reduce risk or amplify the risk. So that's very important for the likes of Nadir or DFM managers to really understand and unpack the risk and return profile of each manager within the industry. But coming back to the question, what is a hedge fund? What is a hedge fund? How is it different to a traditional unit trust? So if we look at the right-hand side, a traditional unit trust typically has a buy and hold strategy. And what that means is an asset manager will buy an asset and your client will get a return if that asset price goes up in value. So that strategy on the right-hand side needs a rising market to generate returns. If we look at hedge funds, we have a lot more tools available to be able to invest in special situations, short selling. For us at Peregrine Capital, we don't do a whole lot of short selling because it does actually amplify the risk. And our aim as a business is to reduce the risk. But again, Ian, this is where a specialist needs to come in and understand the different hedge fund strategies available. But what this means is that we've got more tools available to generate returns for clients during different market cycles. So we have the ability to generate returns not only when the market is going up, but when the market is going down or sideways.
Kavita, can you give me a practical example for the listeners of how a return can be generated? So as an example, if markets are going down, how does your hedge fund or how does a hedge fund practically and simply provide a return?
So that's a great question. So I guess following on, I'd like to take you through an example of a trade that we did. As I mentioned, we use the tools to reduce the overall risk. So if we look at this slide here, on the right-hand side, I'm just going to minimize this so you can see the slide properly. So on the right-hand side is a slide of the S&P 500 index. And at the bottom, you can see it was during COVID. As we all know, towards the end of 2019, early 2020s, when we started hearing about COVID, the story came from China. A couple of weeks later, there were a few cases in Italy, and it was actually over a weekend. There were a few cases on Saturday, and on Sunday, there were a few hundred cases. So our investment team met over the weekend. We looked at the way the numbers were spreading. We extrapolated the numbers out. We also saw that there was no clear way to contain the spread. So what we did, if we look at the right-hand side, is we bought a form of protection, and it works exactly like having insurance. So say you're insured on a house and a house burns down, you would be paid out. In a similar manner, we locked in a higher price where the red circle is on the S&P 500 index. So if in the event the market was to fall, we would be paid out at that high level. And that's really how we use the short book at Peregrine Capital. So it's really to reduce the risk of the overall fund. And Ian, you kind of alluded to the returns for 2020, but this slide here shows you the returns on a monthly basis. And as you can see in March, we have circled first. The black bar here is the JSE. And as COVID came into South Africa, the JSE fell close to 17%. And in that same month, because we had that level of insurance, our high growth fund was down 0.8% and Pure Hedge was up. So these are the two primary funds that we run. In the months to follow, you'll see the JSE actually rebounded nicely, Ian, which also takes me to another point that you mentioned. If you look at all the bull markets or all the upside, typically a hedge fund will not participate in all of that upside. So typically, if you look at our funds, in any given bull market over the past 27 years, we generally participate on 70 to 80% of the upside. But when the markets fall, it's that protection element that really adds value to a client's portfolio. So if we look at the end, where I've circled again, the returns for 2020, the JSE was up 0.6%. Our high growth fund was up 17% and Pure Hedge was up 12%. And these are all after fees. So you can actually see the significance of being able to protect your clients from losing capital. And the insurance actually works in two ways. So upon receiving the payout, we also are able to use that cash to average back into the market at a lower price. So this slide does illustrate how we've been managing money for the past 27 years.
Excellent.
And this is really the core of hedge funds and the value that they can bring to your clients. And this slide here just kind of illustrates that point. As you all know from being advisors in the industry for many years, if your client loses 50% of their portfolio value from today, they actually have to make up 100% just to get back to neutral. So that means that a rand or a dollar of excess return in a down market is actually worth more than a rand of excess return in an up market.
That's very interesting. I think that's a critical, investment philosophy, right? Don't lose money is one of the most key things. So Kavita, can I ask you then, so just for the listeners, so my understanding, so you've got a put, and I'm going to ask you who you buy the put from, but basically it's a contract that basically says the thought is if the market falls, that's when you participate in that contract. So that's the insurance. But if the market continues to climb, that put will essentially not come into play, and essentially just be the cost of the contract that will be absorbed. But what that does is essentially puts a contract in place that says, we foresee that if X happens, this will happen. You can do it on any instrument, right? You can do it on things like, I'm going to use something like, when Musk was with Trump and there was an issue around the concern around Tesla, there was going to be a potential fall. That potential fall in the Tesla stock would be, right, if this happened and there was a vote of no confidence, then if the stock does fall, we are protected. If the market climbs, we still participate. So if my understanding is correct, one, and then two, who do you buy that put from? Who's the contract with?
So it's a great question. So to answer the question of how it works, the put options are priced on the volatility index. So it depends on the market environment. If it's a highly volatile environment, such as in the middle of COVID or in the middle of the war, it's going to be more expensive. So we're currently always weighing up the price of the put option versus the outlook. So typically we have that rolling protection on the funds, which drags down on the performance during a rising market. So as you say, it's the cost that we lose out from. And in terms of who we buy it from, it's exactly the same as how you buy a share, as an example. So from the market maker. So it is very liquid, it is very accessible. And we're talking about global markets. And how we use the put options is mainly at an index level. So the likes of a S&P 500, a NASDAQ, a JSE Top 40, etc. So again, just to highlight the difference between a US hedge fund manager taking a very concentrated single stock bet, because that almost amplifies the risk of a hedge fund strategy. Whereas what we're looking to do is more have that overlay of insurance. So if the market falls, we would be paid out at those predetermined higher levels.
Okay, understood. That's great. Thank you. So we've gone through the benefits in terms, like you said, performance in the down markets, the diversification, that insurance component thereof. But what are the risks? Because obviously with everything, there's a risk and return. But what are the risks that the investor should be aware of?
Well, I think it's important to know that we are regulated. So in terms of the regulated hedge funds, which is what your solutions will be made up of, there are very strict controls in terms of what we can do and what we can't do. One of the things that you mentioned is that hedge funds generally do not participate in that upside. So from here, if the market runs another 20%, it's important to position these hedge funds as more of an insurance component within a broader portfolio and not, overpromise on the upside. It really is a value-added asset class that if the market falls, that's when your client will be protected. So the risk comes in understanding different hedge strategies in the market. And that, I think, is where Nadir and the team come in to really assess how these strategies can complement each other and work together, because that is the real risk. I've had some of my advisors ask me about a specific fund manager that manage income funds, thinking that income is a conservative asset class, but upon unpacking the strategies and the use of how they use the short book, it's actually more of an aggressive strategy. So during market downsides, when you're expected to be protected, you're actually not. So I think that would be a key risk, just to understand each strategy and the risk return profile that it has to offer. I think when looking at an asset manager as well, similar to all asset managers, it's also important to understand their track record, the stability of the investment team and process. And coming back to how put option is used, it's very specialized skill in terms of understanding how to price it, how to use it, and balancing it across different market cycles.
That's very interesting. Nadir, do you want to weigh in on that? I know your thoughts, and we've had quite a lot of conversations around the fixed income space. Obviously, we run the Fibonacci Income Fund, and it's been top performing, but as we had discussion on, it's not like all fixed income funds are created equal. But do you want to weigh anything on the risk perspective?
Yeah, definitely. And I think, look, I think Kavita broadly covered it, but, it's about understanding the different hedge fund strategies that are out there, even within the South African market, which is typically, let's say, a lot more conservative than what you see internationally with the hedge funds that can take pure speculative views and the rest of it. That obviously can't happen in South Africa. But even within the ambit of the hedge fund environment in South Africa, which is well regulated, there's different hedge fund managers that are there to do different things. And I think, from our perspective and the role in the 1618 portfolios, Ian, the biggest risk to watch out for is very clearly understanding what every single hedge fund strategy is in the portfolio to do. So we've got access to the Peregrine, high growth fund. But, we've got to blend that with complementary hedge fund managers that are there to cater to a different environment to what the Peregrine high growth fund is there to do. So it's about clearly understanding the role of each of those hedge fund managers, not doubling up on exposure, and not having any kind of blind spots in creating that composite hedge fund exposure that you want to have in your overall solution.
Oh, interesting. I think it's an important part. So Kavita and Nadir also waiting for this. Can you give the listeners some of the practical insights for product ideas? So how can they use hedge funds in retirement, whether it be with retirement vehicles or discretionary? Give them a practical walk away for today.
Sure. I just want to share my slides again. So I find that our funds or hedge fund managers work really nicely in the likes of a living annuity. And I want to take you through an example and tell you exactly why. So as mentioned, our strategy as a business is to provide a very consistent return profile for clients. And if we look here at the left-hand side, this is a living annuity example, a 1 million Rand investment 10 years ago with a 5,000 Rand monthly income and a 6% annual escalation. If you look at an investment into high growth 10 years ago, 10 years later, that 1 million Rand would be worth 1.9 million Rand. And this really just speaks to the consistency of the return profile. And I've just put as a comparison alongside high growth an investment into the market. So a 1 million Rand investment 10 years ago into the JSE Caps Weeks, 10 years later would be worth 766. And I think the key issue at times is capital preservation, capital growth, especially in the likes of a living annuity. And that's really when hedge fund strategies can help not only preserve, but also grow capital for clients. So high growth, the strategy is to participate 70% on the upside, but more importantly, protect the downside. And even if you look at, so this is the moderate risk fund, even if you look at an example with our conservative fund, so this same example was a 1 million Rand investment, 5,000 Rand drawdown, 6% annual escalation. So this pure hedge fund has similar risks to a stable category or fixed income profile. If you look at the 1 million Rand, 10 years later into a conservative hedge fund would be worth 1.6 million. And as a comparison, I've just taken the best income fund during that period just to show you the return difference. So the 1 million Rand would be worth 1.3 million Rand. So these two strategies will actually complement each other quite nicely because the underlying investments are very different. Yeah. Another product example in the discretionary space is our pure hedge fund. So as mentioned, this is a fund that's been running since inception. During the entire time it's been running, it's never had a negative year. And from a risk perspective, it's very similar to a stable or fixed income category. And in terms of the targeted return for this fund, it's around 12 to 14%. So we aim to deliver low double-digit returns. It's been very widely used in the discretionary space because if we look at the makeup of the returns on the right-hand side, this table shows you the interest income portion is around 3.8%, dividends is around 3%, and capital is over 90%. So if you have a client that's sitting in a large portion of cash or fixed income fund that is paying a high level of tax, if you look at the return difference, so if your clients, this table here shows you the net fund return on the top row. So if your client's earning a 9 or 10% return, after tax, it's actually closer to 5.5%, at best 6% return. Whereas in a pure hedge, you can see the returns. I mean, last year we generated 15.8% as an example, but as mentioned, the fund targets 12 to 14%. So even if we look at a 12% return after tax, your client is getting closer to 10%. So it does also work in, depending on the client's risk profile and the product, it does also work quite nicely in the discretionary space as well.
Kavita, thanks for this. I'm going to ask Nadir to weigh in there, but I think one point I noted here was, I think more than anything then about bullish returns and showing what it's done, which has been fantastic, is consistency of returns and consistency of downside. So if you look at it from a simplistic perspective as well, you know, you annualize a 10% return in 7 years, you've doubled your investments. So you don't have to go 30% up, 25 down to ride that journey to get a consistent valued return. So I think what's taken from that is the consistency of return, minimizing the loss, because obviously you've got to double the return to get back. And there's actually something that Nadir and I prepared, which will also look at the risk to return spectrum, which I think is going to actually validate what you've just shown. Nadir, do you want to speak on anything there?
Yeah, maybe just quickly from my side, Ian. I mean, I think, so ultimately what Kavita is speaking to, particularly on the living annuity examples, that sequencing risk is very important. And unfortunately, you don't know what happens with sequencing risk, and you can't plan exactly what's going to happen in the market at the date you retire, at the date you start drawing that income. And this is exactly why, we've got a well-balanced hedge allocation within all the Regulation 28 compliant models that 1618 is putting forward, is because exactly we want to manage for exactly the risk Kavita is speaking to, which is the sequencing risk. If you had to retire in February 2020, it was a horrible time to retire. The month after you retired, the JSE sold off 17%. The S&P sold off, in excess of 10%. So, all your hard-earned savings over the last 30 years, all of a sudden would have been exposed to this market volatility. The points of, and at the same time, the double whammy, sorry, Ian, would have been that you start drawing the income at exactly the worst possible time. And now, this is exactly why in all the Reg 28 solutions as a start, we think this is such a great addition to these portfolios, obviously within the limits of what the regulation does allow.
What are the limitations? So I was going to actually ask you now. So I think it's important. We're not going to suddenly go 100% into hedge funds.
Yeah.
What are the parameters set of 100% portfolio in retirement, and what can you consider discretionary, Nadir?
Yeah. Okay. So discretionary, and there is no limitation. Discretionary assets you can obviously invest wherever you like. On the compulsory side, so in retirement savings, so whether that be a retirement annuity, a living annuity, a preservation fund, or a pension fund, you are capped at a total of 10% exposure to hedge funds, but that's hedge funds in its entirety. Over and above that, you cap to a maximum of 2.5% per individual hedge fund strategy. So, as an example, Peregrine is one of the hedge fund strategies we including in the 1618 model portfolios. We are capped at a maximum of 2.5% exposure to Peregrine and 10% overall to the asset class.
Okay, interesting. So I was going to actually ask you now. I mean, just for the listeners to be able to gain an idea in terms of how the Peregrine relationship fits into the 1618, and then from a models and a Reg 28 perspective, how do you see that inclusion of where you covered it now? So 10%, 2.5%, is that per asset manager or per fund? So is Peregrine only at 2.5%, or just, for example, their growth fund?
So it's per fund, Ian. So you could have 2.5% in in theory you could have 2.5% in the Peregrine High Growth Fund and 2.5% in the Peregrine Pure Hedge Fund. But it then comes back again to the point we made earlier about understanding exactly why each of the building blocks are in your portfolio, and potentially getting the optimal manager diversification and strategy diversification within that overall cap of 10%.
Okay, I'm happy with that. Kavita, I'm happy with that. Nadir, can I ask you just to get into the numbers? So I'm going to share my screen.
Sure.
You'd obviously prepared some points which we can run through, and I think this will echo very well with what Kavita has actually outlined. Give me a second.
Sure.
Just to, let me know if you can see it.
Yeah, we can see it again. So just unpacking the numbers. I mean, not dissimilar to what Kavita presented earlier. This is obviously on the composite fund of fund level now. So what Kavita presented earlier was obviously Peregrine in isolation, and the Peregrine strategies in isolation. This is now building up to the composite fund of fund solution, or the blend of the different asset managers and the different strategies within a fund of fund solution. But again, Ian, a very similar point. Couple of instances of severe market drawdowns there. October 2018, May 2018 come to mind, and the composite overall hedge fund building block drawing down significantly less. In fact, in certain instances, September 17, Jan 18, Feb 18, the market down and the composite hedge fund actually been up. So, pretty much exactly what you would, made 2019 another good example of that. Pretty much exactly what Kavita mentioned. You want uncorrelated returns to the market. You want diversified sources of return. And by having a fund of funds structure, Ian, you don't want to dilute that message by getting exposure to multiple different hedge funds. You still want that uncorrelated, differentiated source of return that you're getting from a single hedge fund manager. And the point of this chart is just to show exactly that the composite fund of funds strategy doesn't dilute away from that point.
I'm going to switch to the next slide. But for the viewers, what is a capped SWIX? What is that?
Sorry, yeah. The cap SWIX is just the domestic equity. That's just the domestic equity market. So it's just that, in fact, as of December this year, all the JSE indices are being aligned. So there's going to be significantly less confusion. But essentially, the cap SWIX is just a representation of the performance of the overall JSE.
Okay, so equity comparisons, great.
Equity comparison, correct. Yeah. And yeah, Ian, I mean, I won't spend too much time on this slide, but to the point you made earlier, and Kavita has made as well and emphasizes that if you are protecting on the downside, ultimately over the long term, you're going to compound returns and you're going to end up, getting almost equity-like returns with significantly less volatility. So you'll see and this is again on the composite fund of fund level. That's not a single hedge fund strategy, not diluting away from that message. You'll see the blue line over there significantly less volatile than the orange line. But ultimately, you end up in, more or less a similar position. You end up significantly better off than cash and bonds, the fixed income comparison you made earlier. But I think the takeaway point here is that there's significantly less volatility. By protecting on the downside, you don't have to do as much on the upside to end up in the same place, over a full market cycle.
Thank you. And I think just before you jump into this, I think this is, if I can context this for everybody, because it's quite, for those who don't know and what it is, but ultimately the bottom axis, the risk, shows the amount of risk that a fund or an individual will take, with return being the balance of what you would expect from the return side. That actually gives you your risk to reward. And I think this encapsulates a huge amount of what Kavita had illustrated, spoken around the fixed income market, and for me probably was one of the biggest light bulb moments around considering instruments that are lower in risk, similar profile on the equity side, a more stable opportunity for return. So like I said, although these Peregrine funds have done very well, they're not being selected for having done very well. If they had the consistency of like doing a 10 to 12 annually, decreasing the downside risk, you're doubling your money, like we said, in that 6 or 7 years by keeping consistency and using that. So, Nadir, please unpack this a little bit more for those that are listening.
Yeah, so Ian, I'm going to try and keep this as relatable and simple as possible and just use colors here. The bottom line is what you see here is that the orange dots, which represent hedge funds, are equivalent or lower risk to the purple dots, which represent fixed income or bonds. Now, as Kavita mentioned, the common perception in the market is that fixed income is low risk and equity is high risk. Definitely holds true in absolute terms in that, you see the gray dots, which is equity, much further to the right from a risk perspective. The purple dots, which is fixed income, further to the left. Very importantly, the orange dots, which are hedge funds, are in line with, if not lower risk than the fixed income market. So you actually, over a full market cycle, you're actually getting exposure to an asset class which is less volatile than fixed income markets. But then very importantly, on the y-axis, you see the orange dots consistently being higher up on the vertical axis than what you see, the purple dots. So you're getting better returns at similar or lower risk to fixed income markets. And I think this is really the beauty of including hedge fund strategies in your portfolio, is that you're maximizing the amount of return that you're getting relative to the amount of risk that you have to adopt. And I think that's the key takeaway from the slide over here.
And Kavita, do you want to add anything? Because I'm also just looking at the concentration of the dots. So I think that's probably also an important point when you've got retirement planning. Anything you want to add to the slide?
So, I mean, some of my advisors would say, my clients don't mind the volatility, but what I found, sitting on the other side, reporting back to clients is when you have consistent returns during different market cycles, it definitely makes for easier reviews. So the consistent return profile does help. It does provide a much smoother ride. I would say you're avoiding that roller coaster ride of the ups and downs and providing more of that very consistent cable cart ride. And it does have an important effect to clients. They're more likely to stay on track. They're less likely to act emotionally. So the risk return chart, this does illustrate it very, very nicely in terms of still being able to capture the equity upside, but at a much lower risk.
Excellent, thank you. I think that was the, do we need to cover this, Nadir, or I think we're happy from?
Yeah, I think we've broadly covered this again. It's just essentially the spectrum of outcomes is much lower in what you see the fund of hedge fund portfolios. So the average return really is in line with what you get from the market, but the variance in the outcomes is significantly tighter. And it just, again, just a different way of representing exactly what we've been saying consistently through this webinar.
Yeah, so I think just that's actually a good point. So maybe it's worth illustrating. So those listening, you can see the dispersion of return when you look at that South African equity over the given period of time. You've got a -16 to +14. So that's what just Kavita said now about having the cable cart ride is your level of dispersion of risk, of return is much lower when it comes to considering the hedge fund inclusion and what they can actually bring through to the to the portfolios. And lastly, the bond index, which is actually what we just touched on the fixed income side. So even though it's traditionally used to park short-term money, it's used for retirement cash holdings, drawdowns, all of the above. It's got a place in the strategy, but it's important to actually have the right manager and also know that you've got that dispersion of risk depending on which managers are in there, which comes back to utilizing the specialists to look at the portfolio overall. We have the ongoing engagements with the Peregrine team, how that all fits together, so we can look at this from a journey for the investor. Perfect. I think that's fine. We've got that. So let me go back to our questions then. So Kavita, sitting now listening to what the specialists have said, and the investors have got somewhat of a glimpse, and we obviously will be doing more with you because I think these are such relevant and interesting conversation, because we've shown how this can play a role within the portfolios and how even from a discretionary perspective, it would be a great product or investment to consider. But what would you want the listeners as an investor to walk away with that maybe we haven't touched on?
I would say that, it's a very exciting and new asset class that's a lot more accessible. And if you are interested, there's a lot more education around what a hedge fund is. From what I've heard, there's a lot more articles in the media. So your clients probably have a lot better idea of what hedge funds are, wanting to include it. So I would say in terms of walking away, it really is an asset class that can help you protect clients on the downside, provide a nice diversifier. And if you are interested, as an example, we've launched a hedge fund academy. We've got training modules. We're working closely with Ian and Nadir. So I would say, there's a lot of support around this and around the initiatives. So if you do need anything further, you're welcome to reach out to us. But it really can add value to your client's broader portfolio.
Excellent. Thank you. Thank you. Nadir, anything that we've missed out that you think is anything you'd leave the listeners with?
Yeah, so I think the most important point, Ian, is just to understand, exposure to this asset class definitely adds value. This is why we've put forward including it into the 1618 models. And understanding the role that it plays within that composite model. We've obviously got direct long only equity exposure, we've got fixed income exposure, we've got money in money market, which is significantly lower risk. But each of these different building blocks have a role to play within the portfolio, and this is ultimately just another different tool in the toolbox. This is almost the the Swiss Army knife. I just said Army Swiss knife, the Swiss Army knife, if you will, where you've got the multiple different tools, but it's still in the toolbox where you still need the screwdriver, the hammer, the wrench and the pliers and the rest of it. So ultimately just a very versatile tool to include in the toolbox alongside all the other asset classes that we get exposure to in the models.
Thank you. I absolutely agree with you. And I think to draw us to a close here, I've made some notes while we're chatting, and I think the critical items like you mentioned for me is having the category 2A. I don't think we maybe highlighted that enough as a group, and the decision to do that, and the decision is being warranted by what we've experienced today. So the group's decision to bring this to the clients and the advisors, creating that guardrail, having the relationships, the fact that this is a growing regulated environment, so this isn't the Hollywood movies. I think we've been able to show a very high level of sophistication, a very experienced team. I mean, Kavita being one of them, but a specialist team that's focused on hedge funds, 20-odd years experience, with proof in the pudding. The consistency of returns, so I think that was very well illustrated with this being used inside the retirement planning, as we showed. So even on the ability of drawdown with any of the escalation components, it can play a significant role in terms of providing that to the clients, and hopefully in time that 10% will open up further. So I think that from my perspective, I think the hedge funds play a more vital role and should be. I wrote on the cable car, but I like the Swiss Army knife, or the Army Swiss, or the Swiss Army knife, whichever way you wanted to put it, Nadir. I think it's a great call because it provides that opportunity of using sophisticated investment vehicles for the normal retail investor, which is important, what we're trying to achieve for them. Consistent, easy retirement, building up to it, managing the downside returns, and managing the issue of drawing on the downside, which is such a key point. So, Kavita, thank you so much. This was incredibly insightful. We really are looking forward to working more with yourself and the team. We really want to thank you for obviously all the efforts to prepare for today and get us sorted. Nadir, as always a privilege and a pleasure to have you on, and we're excited to obviously present more of this to our team and to the clients as well. So thank you, everybody, and thank you for attending today. We appreciate it.
Ian, thanks so much.
Ian, thanks for facilitating, and good luck to everybody out there.
Thank you.
Cheers, everyone.
Bye.